This market is absolutely fascinating. Live from New York City this morning. Good morning, good morning. Equities melting up. Treasuries at the front end kind of melting down. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, Speaker McCarthy signals more debt deal optimism. As some Fed officials are leaning towards skipping June, Nvidia is absolutely surging after saying all the right things. We begin with the big issue: comforting mood music, uncomfortable reality. House Speaker Kevin McCarthy still sounding optimistic.
I am not going to give up. We're not going to default. We're going to solve this problem. I will stay with it until we can get it done. But let's be honest about this. We have to spend less than we spent last year.
That's the optimism. Here's the reality check. Fitch Ratings warning America's AAA credit rating is under threat. The rating watch negative reflects increased political partisanship that is hindering reaching a resolution to raise or suspend the debt limit despite the fast approaching ex-date. A spokesperson from Treasury responding with the following: the Fitch's warning underscores the need for swift bipartisan action by Congress to avoid a manufactured crisis for our economy. House Democratic Whip Katherine Clark blaming what she calls Republican hostage-taking.
This is not normal. This is a hostage situation. Speaker McCarthy and Patrick McHenry both admitted that avoiding default is the only concession they're willing to offer. And who has the GOP taken hostage? It's not the White House. It's not Congress. It's not Democrats. It's the American people.
JP Morgan's chief U.S. economist Michael Ferro now putting the odds of going through the ex-date at 25%, writing the following: we still think the most likely outcome is a deal signed into law before the ex-date, though we see the odds of passing through that date without an increase in the ceiling at around 25% and rising. Let's get to the Bloomberg team. Anne-Marie and Kelly Dines down in Washington, D.C. Morning, Anne-Marie.
Good morning, John. We're just getting some latest headlines coming from the Capitol. Speaker McCarthy, he is one that is going to be staying here, working through the weekend, while members of the House are actually going home for Memorial Day weekend. First thing he says about that Fitch ratings watch, he's not worried about it. He also said that he's told his negotiators to be working 24/7. I imagine, Jonathan, the people you speak to on Wall Street were already hoping and expecting their legislatures to be working 24/7, because we are now just 7 days away from June 1st, which is the date Treasury Secretary Janet Yellen says could be a highly likely date that could be the start of approaching a default. So Speaker McCarthy, though, yesterday did say he thinks potentially in principle we could get a deal this weekend. And let's just see what happens today. I'm sure there's going to be another meeting, given the sources I'm talking to at the White House and the Speaker saying himself he has these negotiators working 24/7 around the clock.
Kelly, there are a lot of people in this market that couldn't care less about ratings that come from credit rating companies. Should we care about this?
Well, we have to remember what happened in 2011, John. That debt limit impasse ultimately resulting in the S&P Global Ratings downgraded the U.S., losing the AAA credit rating. And we know what happened in the market at that time. Yes, there was a bid into treasuries, but there was turmoil within equities. So it raises the risk of something like that repeating this time around. Now, this rating watch negative from Fitch and also a warning from DBRS Morningstar specifically references political partisanship, the idea that we are rapidly approaching the ex-date, and yet the debt ceiling is not being lifted or suspended. So it raises the point that Treasury Secretary Janet Yellen has made repeatedly, which is the risk isn't just getting to the ex-date, it is also getting too close to it and something like this happening. I would note, though, that you see pushback against the idea of the U.S. actually defaulting even if we get past the ex-date, the idea of prioritization, basically that the Treasury could continue to make some payments, like importantly payments on interest to bondholders, and not make others. Treasury Secretary Janet Yellen, though, has pushed back on that, saying prioritization is just default by another name. Ultimately, though, John, it comes down to what the credit rating agencies think about that.
Anne-Marie, can we just finish on substance? You and I have gone back and forth on this over the last couple of weeks. Ignore the mood music, the headlines, optimism, pessimism. Where are they making progress?
Well, it does seem like as of yesterday, what we heard is the biggest issue, Speaker McCarthy said, is just on spending. So it's always been, Jonathan, from what level they cut and how much they would cut. Remember, Speaker McCarthy continuously says they need to spend less next year than they did this year. The Biden administration says they're happy to spend less, but they need to also see revenue raises. We're still waiting on the exact details of what this spending potential cut could look like, and that has obviously been the biggest issue we are waiting on. The other thing we should note is that Speaker McCarthy this morning, talking to reporters, also said that not everyone is going to be happy with the deal, and I think that's pretty obvious. There's going to be some individuals on the progressive side that are really going to be upset, and already we're hearing it, upset with this White House, and then also those on his right flank that are going to think potentially they gave in too many concessions to the White House to get this deal done.
AMH, Kelly Lyons, to the two of you, thank you. For all the talk of doom and gloom down in Washington, D.C., look at the equity market. Futures right now up 1%. Look at the bond market. There's no rally in treasuries. They're selling off. Yields are higher by 9 basis points to the front end, 447. Let's talk about it with Invesco's Mo Hagbin, PGIM's Lindsay Rosner. Lindsay, can we just start there in the treasury market? Why are treasuries selling off for 10 consecutive days at the very front end on a 2-year?
Well, I think it's exactly what we saw this morning with economic data. The data continues to be strong. We got a really strong GDP number. Next up in terms of importance would be NFP, but we are seeing a strong economy. And then you marry that with the Fed speak that we just got that said everybody really wanted to hike, and that June now is pricing in a 65% chance of a hike. So it seems like the Fed is not done. The data is encouraging. Hopefully we can get through this debt ceiling, and happy to talk about that more. But the big picture long term is that inflation's sticky, economy's strong, and the Fed pretty much is telling us they're going to have to go again.
This from Bank of America in my inbox just moments ago, seconds ago. Don't be so negative on corporate America. Mo, I understand that you're cautious on cyclical assets. Can you walk us through why?
Yeah, good morning, John. So, as you know, we've been defensively positioned, but actually in this market, that's actually paid off quite well. So, growth today and really just the rest of the year, we feel very strongly that, growth over value, and that's really a defensive play, but also market cap, right? We tend to be a little bit higher on the market cap relative to benchmark, and we see that outperformance in large cap versus mid and small. That said, the macro backdrop, I think there's not, it's not all roses and sunshine. Economic growth is slowing, and investor sentiment or risk appetite in the market has been also falling for the last several months. If you kind of look at what's happening with mutual fund flows, for example, we see incredible defensiveness, very conservative asset allocation across the board, elevated cash positions, $5 trillion in money market funds, almost $1 trillion in flows going into money market funds. And that's not even talking about bank deposits, which are very elevated at $17 trillion. So, investor sentiment still hasn't really caught up with what we're seeing with the market, especially today. But we're pretty constructive overall, right? We don't see an issue around kind of a hard landing. We would still be in the soft landing camp. And we are in a multi-asset context, very favorable in the bond space, right? So thinking about locking in yields and going out on the duration curve.
Well, let's talk about cross-asset. Mo, over the last few months, we've just been eating consensus positions alive. Year to date, tech is ripping. Nvidia on my screen is up 29% in the pre-market. No one like that to start the year after a dreadful year last year. You look at the US dollar, the FX market, everyone wanted to get short. Then all of a sudden, dollar strength starts to come through with aggression in the last couple of weeks. We've come down from 110.95 all the way down towards 107 with a potential break of that in today's session. You see this repeatedly, cross-asset, Mo. Why is all that happening? And how much of that is left to push back against in the FX market, in treasuries, as we start to eat out those rate cuts that were priced for the back half of this year?
Yeah, look, I think the forward curve still suggests cuts, so that's a very interesting dynamic. I think to Lindsay's point, we might have another hike, in our near future, and potentially, a pause. But cuts this year seem kind of hard to believe, just given kind of financial conditions and what the markets are doing. To your point, though, it leads us to believe that investors need to be a bit more dynamic, a bit more tactical in terms of their positioning relative to the past. You always have your strategic asset allocation and you position portfolios for the long term. But with this type of market, you also have to be flexible, and we're seeing that today.
Well, let's talk about what's happening today elsewhere and over the last 10 days, Treasuries have been selling off. Lindsay, I mentioned that to open the conversation with you. Do you worry that maybe Treasuries have lost some of those risk mitigation qualities going into what could be a debt ceiling mess? Does that concern you in any way, shape or form? Because for us on this programme, the number one question over the last month or so going into these negotiations was, would Treasuries rally if things got messy down in Washington, or would they do something different this time? Would they sell off because of the inflation backdrop? Lindsay, how do you feel about that question now?
Yeah, I think it's about segmentation in the curve, right? So what we're talking about in the debt ceiling, and John, you and I, Jonathan, have talked about it before, which is front end of the curve, the T-bills in the very beginning. That is not a game worth playing. And in fact, those are up 100 basis points or so since we spoke last. So that's not the area that I think you want to think about in terms of correlations and is that safety. But as you go further out the curve, Treasuries are the risk-free rate. And we started at the top of the hour, there was a discussion about the potential downgrade. That downgrade can happen, by the way, without default. It can happen with prioritization even. So you have this dynamic where maybe the U.S. can be AA by 2 rating agencies, and then from our perspective, from portfolio construction, it's a AA. That being said, if you're in a backdrop where there really are problems, there's still going to be flight to quality. And the flight to quality is to a safe place, which will still be government securities.
So, Lindsay, does that mean it's still Treasuries regardless of the rating? And I remember a conversation I had more than 10 years ago with Bill Blaine at New Edge at the time in London. And Bill was talking about the potential of a downgrade at the time. And he said, you won't sell Treasuries, you'll just sell other things to make space for Treasuries. Isn't that what's going to happen if this does indeed take place?
I think that's absolutely right. For example, when you manage some portfolios, you have an average credit quality minimum, something you have to maintain. And if it's portfolio side, actually the bonds you own in the portfolio, if you have a downgrade and you have notches lower in those treasuries, those mortgages, those agencies, your average credit quality obviously is weaker. In that environment, that's going to be a risk-off environment, right? If there's a downgrade to the U.S., you're going to want to fix your credit quality, and you're going to want to do that by selling lower quality assets. And for us, we've been really conservatively positioned in our portfolios. We are waiting for widening. And so I think that can lead to a really interesting dynamic where you got maybe triple Bs widening, and then we'd go and pick up our favorite names and take advantage of that. So there are dynamics kind of on the margin that can happen if you do in fact have that downgrade. I don't think there's a massive forced selling in the fixed income market, but opportunities will be unlocked, and we want to be there to get them.
Interesting. Lindsay, you're going to stick with us alongside Mo Hagbin. Let's check out the price action right now. Equity futures near session highs, up close to 1%. In the bond market, yields elevated at the front end once again for a 10th session, up 9 basis points, pushing 450 now from 390 back on May 11th. In the FX market, dollar strength, euro weakness, 107.20. And then this one right here, Nvidia, absolutely flying. In the pre-market, up around about 30%. We're talking about adding $200 billion of market cap to this name. I can go through some of the morning calls for you already. From Citi, price target goes from 363 to 420. And they keep it very simple, Abby. They say 11 billion reasons to stay long. And Abby, a lot of people are long this name.
It is unbelievable, this move that we're seeing in NVIDIA, John. And I was just doing some math in the Bloomberg terminal since we're not able to use the SINS function right now. I believe this is going to be the best day because NVIDIA right now up 30%, going all the way back to March of 2020 when it was less than a $2 stock and it made a 42% move. We'll see on the open whether or not that's the case. But it has everything to do with that outlook, basically 40% better than what folks had been looking for, all about AI. And what makes this move so stunning is there had been a lot of naysayers, and I myself was a little bit skeptical. The stock has already doubled on the year going into this monster quarter. Just really unbelievable. Now, the AI that is really transforming the chip space and just the frenzy around AI and what it could mean, that's also helping AMD go higher. Google and Microsoft, we have those chip stocks, or at least AMD being a chip stock, but also Alphabet and Microsoft both also connected to AI. And then we have breaking news on Dish, another stock soaring here, John, up 21%. Wall Street Journal is saying that they're in talks to sell wireless plans for through Amazon. This would help their nascent 5G rollout. Plans are not clear. The details aren't clear, but it could start as soon as June.
Abby,
stocks flying today.
Stock is up big time. NVIDIA, though, the standout. Thank you. Coming up, Fed officials, a split ahead of the June meeting.
It feels to me that they're moving toward a pause. It doesn't surprise me that they're having a debate, though.
That conversation up next.
It feels to me that they're moving toward a pause. It doesn't surprise me that they're having a debate, though, because despite all these rate increases, the economy is holding up pretty well, and I think that's a bit of a surprise.
The latest Federal Reserve minutes capturing the emerging split on the committee. Several participants noting that if the economy evolved along the lines of their current outlooks, then further policy firming may not be necessary. Compare that to this. Some participants commented that based on their expectations that progress in returning inflation to 2% could continue to be unacceptably slow. Additional policy firming would likely be warranted. Governor Waller trying to make his position clearer. I do not support stopping rate hikes unless we get clear evidence that inflation is moving down towards our 2% objective. But whether we should hike or skip at the June meeting will depend on how the data comes in the next 3 weeks. So here's the calendar for the next 3 weeks. June 2nd is payrolls, June 13th is CPI, and perhaps a debt ceiling solution somewhere in between. Mike McKee has more. Morning, Mike.
Yeah, morning, John. Well, it was a very interesting set of minutes because, as you pointed out, there was a clear division between the some and several camps. First, let's define what that means. The Fed has code words for how many people are speaking about a particular topic, and according to a 2017 Fed paper, this in descending order is what they mean, and as you can see, some is more than several. Now, who is in what camp? That's a good question. We've sorted them a little bit here again. Put the sorting hat on again. And the team worried is Bowman, Waller, Kashkari, and Logan. The team paused Powell, Jefferson, Harker, Goolsbee. Now, there are more people in the worried camp, in the some camp, but the number of voters is exactly the same in both. And there are 3 voters who haven't yet really offered us their opinion. So we're going to have to wait to get a better idea of what's going to happen in June. And that is, of course, because we're waiting for those things that John just talked about in terms of a calendar. Inflation has just not slowed down enough is the argument that they're all making. You can see that in the red box there. That's core PCE, which we get tomorrow. It is basically flat for the last couple of months. And because it's not going down any faster, the question is, do you continue to raise in June, or do you wait and see what happens and possibly raise in July? Markets are pricing July now, John. Especially after that claims print. Mike McKee, thank you. Mike broke down a claims number a little bit earlier. Downward revisions, 225 to the previous week. 229 is the new number now. 229. The estimate was 245. The previous number, 225. So 229. We're sub 230 on claims. Lindsay Rosner's back with us alongside Mo Hagbin. Lindsay, are we on course now for a skip in June and a hike in July?
I think a skip is hard, right? A skip is hard because how do you message that properly? If we pause and then decide to hike or decide to cut, every single time that there is a pause, there will be a question if there's going to be a reacceleration of rates. So I would argue that this is the most difficult, challenging time that this Fed has faced in terms of how to message and how to think of things. The data, as Mike said, is going to be crucial to tell us what they're going to do. I think we really need that data to have a better read. But as I mentioned, the market is pricing in a 65% chance of a hike in June, and that seems decently reasonable. And in the back end, in terms of what we're seeing for cuts, that's almost all been removed. 14 basis points only in cuts from here as of this morning. So really dramatic changes based upon all this speak, based upon all this data, and then you got the debt ceiling thrown into the middle of it.
And
so
let's see if we
it's
can,
an interesting time.
If we can escape the debt ceiling drama as well, you wonder how much upside is left in that conversation. Mo, you wonder how much upside is left to the tech story as well. I think that's what's interesting about what's developing in tech at the same time what is developing in the bond market. You've got this situation, Mo, where yields are pushing higher. We've got 5% rates at the Fed with the prospect of pushing them out further, maybe even up a little bit more from here. And yet you've got this monster rally in these story stocks around AI. Mo, are they names you want to stick with?
Yeah, so John, I think in an environment where growth is kind of below trend or kind of slowing down, actually, that is a very, logical place to go. Investors generally chase growth when growth is slowing, right? So in a way, that's a defensive story in our opinion. So looking at higher quality companies, larger companies, and moving away from the more pro-cyclical parts of the market, right? So your traditional small cap and value names seems to be, here to stay for a bit. We're positioned that way. We have been positioned that way since March. And, I think the momentum traders will start to come in as well, right? So if you think about momentum strategies last year, they had really kind of moved more towards that pro-cyclical side of the equity market. So value names, financials, some of the sectors that are maybe more levered to the business cycle. That's changed this year, right? With the NASDAQ outperforming, the S&P outperforming the Dow. And, you look at small caps, you're barely in positive territory at the moment. So I think it stays that way for some time. And that's really more of a defensive positioning on the equity side rather than anything else from a sector perspective, in my opinion.
Hey, Mo, appreciate your time. Mo Hagbin there alongside the brilliant Lindsay Rosner. Thank you to both of you. Here's the price action right now. Big moves, up 0.8% on the S&P, absolutely flying on the NASDAQ 100, up around about 2.3% right now. Yields up and away in the Treasury market on the 2-year, just fading just a touch, but still higher by 6 basis points. 443 on a 2-year. And in the FX market, off the back of that dollar strength, the euro against the dollar, euro-dollar 107.24, lower the session 107.14. That currency pair right now, 107.24, and negative about 0.2%. And the stock at the moment is this one right here. Nvidia is just absolutely amazing. The stock is up by 29% in early trading. I'm told that if we get to 32.41% on that particular stock in the pre-market, if we get to 32.41% higher, that means that market cap's gone from 755 billion to 1 trillion. So we're talking about $200 billion plus of market cap being added to one name off the back of the guidance from yesterday. Up next, the morning calls. I'll break down some of the calls on that name as big tech gets even bigger with a boost from Nvidia, delivering monster guidance and shattering estimates. That conversation up shortly with JP Morgan's Jordan Jackson. 25 seconds away from the opening bow this morning. Good morning. About to add some weight to this rally year today on the NASDAQ. The NASDAQ flying at more than 2% going into the cash open. Equity futures on the S&P 500 positive as well, up by 0.85%. It's all down to one name at the moment. We'll talk about that one name in a moment. Let's see opening bow, switch on the board and get to the bond market. Yields look like this, higher by a single basis point on a 10-year. Up a basis point to 375.55. Big moves at the front end over the last 10 days. 10 consecutive days of yields higher, up another 7 or 8 basis points on a 2-year. 445. Coming with that, some dollar strength, euro weakness, euro dollar 107.20, negative by 0.3%, and crude backing away as well. We're down by about 2.7%, 72.40 on WTI right now. About 20 seconds into the session, equities positive by almost 0.9% on the S&P. On the NASDAQ, up by 1.8%. One stock to watch at the open, Nvidia. Shares hitting an all-time high after delivering blowout results on robust demand for AI processors. The company inching ever closer to a $1 trillion market cap. Alex Webb has more. Morning, Alex.
Morning, John. Yeah, really quite extraordinary numbers coming out of Nvidia. The expectation from the market was that the current quarter revenue would be in the order of $7 billion. The company's now predicting $11 billion. That's a 53% increase on expectations. This is all really coming from the nature of the way AI is being rolled out. It is being pushed by Google. It is being pushed by Microsoft for their cloud businesses. If you are doing AI stuff in the cloud, they say you need then to have the AI chips doing it. Nvidia makes those chips. Demand is surging, and that's why we're seeing this sort of eye-watering $200 billion pop in the valuation today.
Alex, is it the size or the immediacy of their ability to monetize this emerging trend?
It's the fact that it is immediate, but there is expectation for quite a long tail. At the moment, we're seeing Google and Microsoft do this for the bleeding edge applications. there is huge expectation that this will go into all sorts of compute power over the next few years. There had been some concern maybe that there wasn't enough capacity at the foundries that actually make these chips, the likes of TSMC. The fact that they are able to ramp up production on the scale they're telegraphing today suggests that that is not a concern. They have capacity to make these, the supply is there, and the demand is clearly there too.
Adding some big market cap to this name in one session. Alex Webb, thank you, buddy. We're adding about 189 billion US dollars in market cap to one name in just a couple of minutes of trading off the back of all of this, and some big upgrades to the price targets that we've seen on the south side. Let's just go through them one by one. Citi, price target goes from 363 to 420. Piper Sandler, price target goes from 300 to 440. Barclays from 275 to 500. JP Morgan, look at that, 250 to 500. They've doubled their price target on this name. Just a monster move on Nvidia. Counts for about 5.5%, 6% of the Nasdaq 100. It's pushing the Nasdaq higher, pushing the S&P 500 higher by something like 0.6% this morning. It's almost boring to talk about anything else, but we got to turn to retail. Best Buy topping profit estimates and maintaining its outlook unveiled back in March. The company's CEO weighing in on the challenging macro environment, saying customers are clearly feeling cautious and making trade-off decisions as they continue to deal with higher inflation and low consumer confidence. Kaylee has more. Hey, Kaylee.
Yeah, John, a 3% move here at the open doesn't actually seem all that exciting, but Best Buy may be excited to see a light, if you will, at the end of the tunnel. The first quarter, they did beat earnings expectations, but comp sales were down 10%, and they expect they will be down up to 8% in the second quarter. As you said, though, they do stick to their full year guidance, which is expecting a comp sales decline of no more than 6%, which suggests that they do expect that these declines will be moderating in the second half of the year. The company's CEO saying that they continue to expect that 2023 is going to represent the bottom in the decline of tech demand. Of course, they've really been struggling over the last year as consumers pulled back on discretionary spending for electronics specifically. And I would note analysts today sounding pretty positive after this report as well. Evercore ISI talking about how this is better than feared, considering they're sticking with the full year guidance. And our analysts here at Bloomberg Intelligence also note that operating margin seems to be moving in the right direction, which could help the company meet its profitability goals. So up 2.25% here at the opening bell. I tried my best to make that exciting, John.
Kelly, you did. Of course you did. Of course. I mean, 3% on Best Buy compared to Nvidia right now. Kelly, thank you as always. Let's stick with retail and the earnings from Dollar Tree, moving sharply lower after slashing its profit outlook. The CEO saying the following: while we're seeing early results from our initiatives, we're not immune to the external pressures affecting all of retail, notably the margin impact of elevated shrink and the product mix shift to consumables. Abby has more. Hey, Abby.
Hey, John. And we're now looking at the worst day for the shares of Dollar Tree going back to March of 2020, with this stock down about 16%. Now negative on the year. Coming into today, it had been up 10%, but now a decliner. And it has everything to do with their profit situation. Now sales of $7.3 billion, basically in line, but earnings of $1.47 missed by 4%. But more importantly, that's a year-over-year decline of more than 20%. A number of factors weighing here. Tough comps. It's really, again, that profit picture that's worrisome, though. The shift in demand to lower margin food, legal costs from a rat infestation at a warehouse, an increase in what's called shrink. That's basically a fancy retail word for losses due to stealing. So the messaging is consistent here, though, with what we heard out of Walmart and Target relative to consumers being tight, but especially around the lower income consumer, forcing U.S. shoppers to go toward food that's less expensive and also spend less on discretionary. The new management team, John, really has their work cut out for them.
Stock down 15% right now. Abby, thanks for that. Let's turn to higher end retail. Ralph Lauren topping Q4 earnings estimates. The brand says it's still seeing strong consumer growth and acquisition despite declining revenue in both Europe and North America. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, Ralph Lauren has pricing power. That's what you need to know. This was interesting. The brand increased prices by 12% for both the 4-year and the fourth quarter. That helped to boost some of their earnings in the face of pretty sticky inflation, like you said, maybe some slowing sales. But let's get into some of the numbers, because fourth quarter adjusted EPS came in at 90 cents. The estimate was for just 60 cents, so a big beat there. Net revenue came in at $1.54 billion. Again, the estimate was for about $1.47 billion. So some big beats there, really coming back to those price hikes, and the company saying there could be more to come. Specifically, it said that it expects to continue to be able to raise its average retail prices in the current year. You can see shareholders pretty psyched about that. Currently, Ralph Lauren up about 6.2%.
Katie, thank you. Just to bring the audience an update on what we're hearing from Speaker McCarthy, House Speaker Kevin McCarthy speaking to a US broadcaster, Fox News, a little bit earlier. This is what he had to say. Very difficult for Democrats to agree to spend less, although he did indicate that we've made progress on debt limit talks as of yesterday. He makes this statement that it's very difficult for Democrats to agree to spend less. Let's see if they can find an agreement. Right now, more broadly, this equity market is doing okay. As McCarthy says, we'll get this deal done at the end of the day. I think a lot of people still feel that way. Look at the bond market, Treasury yields higher by 7 or 8 basis points on a 2-year, 4.45. Just pricing in higher interest rates again, or rather taking out those rate cuts we'd priced for the second half of the year. As we do that, we start to bake in some dollar strength. The euro breaking down to 107.12. That's a new session low right now. Let's see if we break 107 on the single currency after coming that close to 111 several months ago. But this broader market, the lift we're getting is from one name at the moment, NVIDIA, absolutely flying. Dan Hives of Wedbush had this to say. He read the following: NVIDIA gave jaw-dropping, robust guidance that will be heard around the world. For any investor calling this an AI bubble, we would point them to this quarter, cementing our bullish thesis and speaking to the fourth industrial revolution now on the doorstep with AI. That was well-known tech bull Dan Ives. Here's what else we've heard recently on Big Tech.
Technology is fantastic, but also, as we know, these biggest names are driven by the excitement for AI. The tech trade has been in the largest cap techs.
As you look out more, 6 to 12 months, we think tech will continue to be leadership.
It's not really the whole NASDAQ I like. I like those components, which sits in the AI and the chat GPT.
As rates have gone higher, tech has done better. Technology is still bolstered by CapEx. I think that a crash scenario is probably unlikely.
More bull market stability might help things like tech.
We love technology.
Joining us now is Jordan Jackson of JP Morgan Asset Management. Jordan, I've got to start with this one. It's a difficult one for a lot of people. Are we on the brink of a melt up or a melt down?
I think we're on the brink of a sideways market. I don't think that I'd like to see broader participation from the rest of the market. You certainly have continued to see big tech continue to hang in there. But I think more or less markets are pricing in this softish landing, right? This idea that the economy can avoid a recession amidst higher rates, amidst tighter banking conditions. But I think I struggle with sort of the fundamental story here. I still think earnings outlook still looks too optimistic from our viewpoint. And when I think about fundamentals and where the rate markets are currently pricing in their expectations for Fed policy, I struggle with the current valuation on the market as well. Obviously, the debt ceiling adds another layer of uncertainty. And so I think we're in store for a pretty sideways market. Now, this doesn't mean that big tech can continue to rally. I think that story continues to be much more of a micro story, right? Recognizing that tech continues to be fairly profitable, surprising on earnings, generally speaking. And so that suggests, maybe there's still a bit of legs. But as I look out maybe 6 to 12 months, I think fundamentally and maybe the valuation component becomes a little bit more challenging.
Well, Jordan, right now, though, to call that a micro story, it makes up a major chunk of the S&P 500. Can you really bet against that?
So look, from a price standpoint, right, when tech sneezes, the rest of the market is going to catch a cold. It's just because of the sheer weight. But again, we like to see when you look at the relative performance of the equal weight index relative to the S&P 500 more broadly, and market cap weighted, that severely underperformed. And that tends to, for me, I struggle with the durability of a broad, sustainable rally. And again, I think this will start to move towards a more macro story as you get further potential, at least less tightening from the Fed, more cautious potentially from the Fed, and that may be signaling a more severe recession. And I'm particularly worried about some of the stresses in the regional banking sector, and that broadening out to the broader economy, leading into a recession. Remember, tech may be leaning a bit more quality these days, but it's still cyclical. Right? And so if you get that recession, then again, I think you'll start to see some pressure in big tech.
Talk to me about what you think the relationship should be between what's developing in the bond market and equities right now, and how you would characterize how it's played out recently. Because right now on my screen, yields up, stocks up. Is that going to change?
Well, it's interesting. The risk-free market, just looking at the yield curve, is signaling that recession, right? It's signaling that economic slowdown. And when you look at credit markets within the bond market, they're also more or less in the camp of a soft landing, similarly with equities. With the exception of bank spreads that have really gapped out, the rest of the credit market spreads still look fairly tight. And so you're in this environment in which I think the risk-free markets are pricing in that recession. Risk assets are not. They're still pricing in that soft landing, and it will be until we start to see some of the hard data come through that suggests that the economy is in fact weakening, that you'll start to see that macro story take hold, and I think you'll see a bit of volatility, choppiness in risk assets.
Jordan, where we are seeing weakness is abroad now. The data surprises out of Europe, ugly. Some of the data out of China, disappointing. Do you see any durable tailwinds in the rest of the world equity market story that so many people got bulled up on coming into 23?
So I guess my sort of out of consensus call is maybe some tactical upside to traditional energy and oil prices here. I think you're seeing domestic demand from domestic consumers coming from China fairly weak. And I think from that perspective, China is going to go into its old playbook and start to build out some of the fiscal stimulus and boost some of its fixed asset investment to try to boost some of its GDP numbers over the next couple of quarters. Also, if you look at sort of OPEC Plus, they've already announced some production cuts. And when you look at economies like Malaysia and Nigeria, for an example, they've been underproducing relative to those production quotas already. And that sets up a backdrop of lower degrees of inventories. And the last point that I would make is I've been somewhat surprised that the U.S. did not take the opportunity to rebuild up the SPR. And so we could be very well entering into a period in which demand sort of hangs in there, but the supply side becomes a bit of a challenge. And that could be a bit of a tailwind into oil prices.
Well, based on prices right now, they might have another chance. Jordan, thank you, sir. As always, Jordan Jackson there of JP Morgan. Crude right now back in by 2.8%. WTI 72. That's not the price you want, I know. So let's get it on the screen. Nvidia flying. 378 at the moment in early trading. We are higher by, what are we now? Up by about 24% on Nvidia right now. Coming up, Governor Ron DeSantis and his big announcement, not going to plan.
We're just trying to get it going because there's so many people.
It's unfortunate. I'd like to never seen this before from Governor DeSantis for this.
That conversation up next.
This is Bloomberg The Open. I'm Lisa Mateo, live in the principal room. Coming up, Klarna Holdings CEO and co-founder Sebastian Siemiatkowski. That conversation at 12:30 p.m. Eastern, 5:30 p.m. in London. This is Bloomberg.
Governor DeSantis choosing to make his big announcement on Twitter.
Now it's quiet. All right, sorry about that. We've got so many people here that I think we are kind of melting the servers, which is a good sign. Thank you for putting up with these technical issues. I think we're definitely breaking new ground here. As far as I know, no major presidential candidate has ever announced their candidacy on social media this way. Certainly in a Twitter space. Steve, do you have a comment or question? I think you just need to unmute. If Steve can unmute, then we'll go ahead and ask him for a question. If not, we'll keep rolling here. All right, 3, 2, going.
I'm there,
all right,
guys.
sorry, Steve.
I'm there, guys.
Oh, there you go. All right.
Yeah, my bad.
Audio feedback glitches, accidental muting. Florida Governor Ron DeSantis looking to make the most of the difficulties.
We had a huge audience. It was the biggest they'd ever had. It did break the Twitter space. And so we're really excited with the enthusiasm.
Let's get to the team coverage. Bloomberg's Anne-Marie over in Washington alongside Mandeep Singh here in New York. AMH, how did that go?
Well, the New York Times called it a conference call from hell. And Jonathan, I know you at points were also listening in, and it was frustrating, right? Because you wanted to hear from Governor DeSantis, this highly watched candidate. Everyone's been waiting for him to make this announcement. It was supposed to start at 6 p.m. All these technical glitches. He didn't actually say he'd be running for president till 6:26 p.m. So obviously some frustration, I imagine, with those that were trying to listen in. They're spinning it as he, quote unquote, broke the internet. I think it remains to be seen what happens next. They were able to bring in about $1 million following that announcement. And right now for that DeSantis camp, it's going to be all about the fundraising. How much are they going to leverage all this, him entering the race, and potentially where this goes from here? Because, Jonathan, one key aspect that he definitely wanted to try to really come across yesterday is that he could be like Trump, but without the drama, obviously without really talking about the former president. The issue is the former president has doubled his lead on Ron DeSantis since March.
So bad it's good. That's one way of looking at it. So bad that it's good. We're all talking about it. The obvious predictable takes from a lot of people in the media, we've all read them this morning. You read some of that a little bit earlier, Anne-Marie. Mandeep, was it so bad it's good? For the platform, not for the candidate.
I think I've seen Twitter Spaces with over 1 million users. So clearly, the number of concurrent users caused a lot of difficulties for the platform. But to me, this is just, them not rehearsing this and not anticipating this kind of scale when it comes to this particular event. Look, I think people will forget, especially what they're trying to do with this is to target the younger demographic and, outside the linear TV channels that candidates typically use. So to my mind, they're going to use this more and more, and eventually they'll get used to it. But clearly, in terms of the viability of the platform, we are going to see more of this in this election.
Anne-Marie, we've got 18 months of runway, if he wants it, to carry on campaigning. To Mandeep's point, and we talked about this yesterday, these things can be forgotten pretty quickly. They feel terrible the morning after. But ultimately, what's the plan from here? What is the campaign going to look like? And what's the difference going to be between this candidate and the front runner right now, former President Donald Trump?
Well, I think one thing was clear yesterday. They wanted to do something a little bit different, something out of the box. What really struck me is I think this would have been the first candidate since FDR that has said, asking Americans to vote for him, saying, I want your vote, and was not on camera. But shortly after that, he did do an interview with Fox News. So you could see that they're definitely going to, at some point, also incorporate traditional media. And I think probably, Jonathan, that's where you're going to see this go. They're going to want to reach out to some more traditional networks after this interesting Twitter Space launch.
Interesting is one way of putting it. Here's something that's genuinely interesting. NVIDIA. I can't let you go, Mandeep, without bringing this up. The stock's up by 23%. Mandeep, what are you telling customers, clients at the moment, friends even, about what's developing here?
Well, so I think it's for a good reason. The fundamentals are strong. And anytime you see a company expanding their gross margin at this scale, it's a clear sign of pricing power. Everybody wants their chips. That's what's driving the demand. I do think valuation-wise, there's a lot priced in, but that's why, the results yesterday were a reflection of how good the demand is and how it is translating into their outlook.
Mandeep, as you said on Bloomberg Surveillance earlier, you could have said exactly the same thing last week. And then we saw the numbers overnight. Just amazing. Mandeep, thank you. AMH, tremendous coverage, as always, down in Washington, outside the White House. NVIDIA up by about 23% at the moment with some sector price action. Here's Abby.
A wild sector action, John. We have the S&P 500 up just about 0.5%, but a lot of sectors either up or down more than 1%. Sticking with NVIDIA, we have the tech space up 2.9%, flipping between the best day since January or November of last year on that NVIDIA and AI strength. But to the downside, we have energy down 2%, and then we have lots of the defensive sectors, utilities, healthcare, and consumer staples with yields soaring, investors not wanting those dividends, plus with NVIDIA and tech, who wants the safety. But let's stick with NVIDIA. I know we would usually look at a sector here, but on the year, up 158%. I got a little ahead over my skis the other day, or earlier, John, but this is the best year right now since 2016.
Market cap, $934 billion US. Your trading diary up next. 26 minutes into the session, equity still positive on the S&P 500, the Nasdaq. That's the price action. Here's the trading diary. Boston Fed President Susan Collins speaking from Rhode Island, 10:30 Eastern Time. Costco reporting earnings later. Plus, we'll get earnings from the Gap as well. US PCE, inflation and UMich sentiment survey will round things out tomorrow. And looking ahead to next week, US markets, of course, close for Memorial Day on Monday from New York City. That does it for me. Thank you for choosing Bloomberg TV and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.